I'm Teal Whitaker. I'm the Director of Communications at the Montana Community Foundation. And I am here to just share a few housekeeping things before we get started. The first one being, if you can please keep yourself on mute throughout the presentation, not our presenters, of course, but that just helps eliminate any background noise. I think we're all kind of aware of this now that we live in the Zoom world a lot more. I also just want to let you know if any burning questions do come up throughout the presentation, please feel free to ask those in the chat and we'll work to get those answered. There also will be an opportunity at the end of the presentation for a little Q&A. Lastly, this presentation is being recorded and we will have it available starting tomorrow on our website. So with that, before we get into the investment update here, I'm going to introduce Mary Rutherford. I know many of you already know her. She's our president and CEO here at the Montana Community Foundation. And she's just going to share a little update about the Montana Community Foundation. Thank you.
Thanks, Teal. Hi, everyone. As I said earlier, it's so great to see you all. And it's obvious by taking a peek at your backgrounds that not all of us have fully returned to in-office work. Many of us continue to work a hybrid fashion. Some of us are in the office part-time, some of us are working remotely, and we continue to do that at the Community Foundation as well. Happy to just give you a few updates, but first just recognizing that sometimes this time is a little tough on all of us. Many of us have had friends and acquaintances and loved ones affected by this pandemic very directly and indirectly. And just want to acknowledge that it's a tough time and we're all figuring out how we get through it. Using a quote from a dear friend of mine, my aunt actually, normal is just a setting on the dryer. So we're figuring out how to adjust and navigate through this pandemic. So thanks for hanging in there. Thanks for joining us today. We're really excited to have you with us, and we're equally excited to have Omar and his team from Cambridge. I want to just give you a quick update on a couple things at the Community Foundation. First and foremost, I'm thrilled to tell you we're fully staffed. And as we all know, with the situation in the world today, it's not easy having staff and keeping staff, and we're thrilled to announce that we are fully staffed. We've added 2 philanthropy staff to our team. Many of you know Heather O's. She is based in Billings, and Jim Bennett is up in Havre. Jim also serves on the board of the Hill County Community Foundation, and so we're thrilled to have that continued a strong connection with our Community Foundation partners. And our finance team is rounded out with the addition of Diane as our staff accountant. And finally, we have Kelly Curtis, who's joined us serving as our AmeriCorps Vista for the next year. And she's working primarily with the Women's Foundation of Montana. So we now are fully staffed with a team of 19 with locations in Helena and Missoula and Big Fork, Havre, and Billings. So proud to be your partner in philanthropy. At the Montana Community Foundation, we now have over $150 million in total assets. So very excited about that. In more than 1,400 distinct funds and planned gifts. So planned giving continues to be a huge part of the work that we do to provide sustainable funding to the benefit of Montana charitable organizations. We're just finishing up our granting from our COVID fund. I'd like to say we were finishing it up, but we just received another, I think, $50,000 contribution to that fund. But we awarded over $400,000 across Montana to support rural and tribal communities as they recover from this pandemic and however they define recovery in their own local communities. And finally, this is the week of Veterans Day. And many of you who've been with us for a while remember that the Montana Community Foundation was the fiscal sponsor of the Big Sky Honor Flight. And we continue building on that work with our Montana Veterans Fund. Any of you on our call today who are veterans or family members of veterans, thank you for your service and sacrifice, because as the daughter-in-law and the mom of a veteran, I understand what that sacrifice looks like. And so we're grateful for people who've raised their hand and are willing to serve our country. We have just made a great grant from the Veterans Fund, $20,000 going out to serve organizations that serve veterans. So the Adaptive Performance Center in Billings will be receiving a grant from that fund, the great organization. And then also tribal veteran centers across Montana, Flathead, Blackfeet, Fort Peck, and the Northern Cheyenne Reservation. So if you want to help support the work that we're doing through the Montana Veterans Fund, you can make a gift right online on our website. So thank you for your generosity thus far. We're continuously grateful to be your partner in philanthropy. And without much further ado, I'd love to turn it over to Omar Sanchez, who is our outsourced Chief Investment Officer with Cambridge Associates. And Omar's been with us for 5 years or so now. And so Omar, I'd be happy to have you introduce your team and just go right into our investment webinar. Thanks folks for joining us. I'm going to go on mute now.
Thank you, Mary. Delighted to be here today with you all. As Mary said, I'm Omar Sanchez, CIO at Cambridge Associates, and we've had the honor of working with the foundation for just over 5 years, which is really hard to believe how quickly that time has passed. I am joined today by my colleague, Tim Shepard, who is our Director of Portfolio Strategy on the team, and Sam Camden, who is our analyst and does all the heavy analytical work that we do on the team and is very much responsible for these materials today, and will be driving the presentation today. So in terms of an agenda, there are sort of 4 items that we were thinking we'd like to cover. We'll do our best to be relatively brief so we can create plenty of space for questions. We'll start with a very brief overview of Cambridge Associates, who we are and what do we do. We will spend a few minutes on our investment approach as a team, because we think it provides helpful context for how we think about managing the portfolio and making investments on behalf of the foundation. We will then look at market returns for the calendar to date as a way to provide some context around performance of the portfolio for the year to date and for trailing periods as well. And that will be a nice time to spend focused on that. As I said, please feel free to utilize that chat function to ask any questions that you have, and we'll do our best to be efficient so that we can create that space for questions. Sam, if I could have you pull up the very first page, portfolio highlights. We'll give you some of the headline numbers first, and then we'll go a little bit deeper later in the presentation on performance. Thank you, Sam. So this is what we call our portfolio highlights dashboard. It's meant to provide really all of the key data points that you would want to be aware of as you look at the performance and positioning of the portfolio. So we'll start in the left-hand corner of the page, portfolio asset allocation. At the end of the third quarter, total portfolio assets stood at just shy of $131 million, $130.6 million to be precise, well diversified across public equities, which are the blue slices of that chart, private investments, which is the green, diversifying strategies, which is a combination of traditional hedge funds, long-short equity, event-driven hedge funds, as well as some less correlated liquid alternatives. And then assets meant to provide a degree of liquidity to the portfolio, particularly relative to particularly challenging macroeconomic environments, just to give some flexibility both for supporting spend and some flexibility for rebalancing across commodities, tips, treasuries, and cash. If you look at the portfolio snapshot table directly in the middle of this slide, this is the positioning of the portfolio across the main investment categories that we have, again, public equities, private investments, and so forth. And then directly beneath, showing you performance, starting with the third quarter, you can see the portfolio was slightly down in the third quarter, down about 20 basis points relative to the policy benchmark, which was down 10 basis points. But what we also would highlight here is relative to global equities, which ended the quarter down about 1%, a degree of downside protection. which is a function of the investments that we have in the portfolio and the diversification that we have in the portfolio. And it is a profile that over time you should expect to see, which is to say, in down markets, this portfolio will have down performance, but it should protect capital relative to an under-diversified portfolio and basically keep us in the game until markets recover. For the calendar year to date, you can see the return there of 10.3% against 8.7% for the benchmark. So about 160 basis points of value added. And that's net, that's net of manager fees, that's net of Cambridge fees. About 93% of the upside capture relative to broader global equities over this period, which were up for the year to date 11.1%. And then when you look at the trailing periods, the trailing 3-year and then since inception, which is just over 5 years, some nice value added against the benchmark and decent level of up market capture overall, or market capture, I should say, overall, relative to what you get from broader global equities, but would note with substantially less volatility than you would experience if you just held a basket of equities. We have numbers in terms of estimates for October, so to be very clear, these are estimates, but it's looking like the portfolio was tracking at another 3.1% positive for the month of October, and that would put the year-to-date return for the portfolio at 12.5% positive, and that would put the market value of this portfolio at 134.5 million through the end of October. Turning briefly to performance drivers for calendar year, US equity and private investments were our highest performing allocations in the portfolio. US equities were up 15.4%, and the private investments were up 30.2% for the calendar year to date. The one negative area of attribution here is the treasuries. We hold a basket of treasuries in the portfolio. They were down just over 5% on the year, purely a function of the move in interest rates, which have been gradually moving up for the better part of this year. Anything with duration has been impacted in terms of the price of those types of bond investments as a result of that move in interest rates. On a relative basis, really the standout performers, again, would note the private investments up just over 30% against their benchmark, which is up 12.4%. And then non-US developed equities, those managers have delivered very strong absolute and relative returns this year, up 10.6% against 9.2% for the benchmark. And then on the negative side of the ledger, just a little bit of what we call tracking error in the treasuries, a little bit under their benchmark. They were down about 5.6%. The benchmark was down 5%, so nothing that noteworthy, would say. And then US equities, again, delivering very strong returns, but relative to their benchmark, just a little bit of underperformance. US equities, again, up 15.4% against the US equity benchmark, which was up 15.9%. So what I'd like to do now is we'll spend a very brief period of time here on Cambridge, who we are, what we do, particularly with a focus on OCIO, just to provide that reference point for folks who might be less familiar. We'll spend a few more minutes on investment philosophy, as I said, because it really is it's really the bedrock of how we think about managing portfolios and making investments on behalf of the foundation. And then we'll get into those market returns and a deeper dive on portfolio performance. So Sam, if I could ask you to go to page 6. Thank you very much. So very brief background on the firm. As you can see, when we show you these highlights here, we've been serving as an OCIO for our clients for close to 20 years now. We have about 80 plus clients that we help manage their portfolios on a discretionary basis. That represents about $54 billion in assets under management. And what we'd like to think, I should say, differentiates us is a combination of our experience, close to 50 years at the leading edge of portfolio management, innovative thinking in investments for institutional clients, resources. We have a truly global research platform that's designed to scour the investment landscape and find the best ideas out there and get our clients access to them. And then lastly, alignment. We have one line of business, which means we have no other business agendas competing for our best ideas. And so when we're making these investments, when you see an investment in the portfolio, it's because we think it's the best thing for this portfolio, not because of some other reason. So our interests are very well aligned. In terms of the OCIO business itself, we really built it to replicate the best practices of leading in-house investment offices. And that very much starts with a high-touch partnership. So if we could turn to the next page, we'll take a look at the team. This is the foundation's investment team. And as I said, it really starts with a high-touch partnership that has to be based on mutual confidence and trust. How do we build and establish and really cultivate that trust? We start by getting to know the foundation really well so that we can understand really what the broader operating dynamics of the foundation is, what the risk tolerance of, in this case, the investment committee is, and so that we can build the highest performing portfolio within that risk tolerance. And we do that as well so that the foundation can understand and we make sure, I should say, that when we work with the foundation, we make sure that everybody understands every risk in the portfolio and why these investments are there so that they can have the highest conviction in the investment strategy that we develop together. So as I said, we are the foundation's investment team. We are fully resourced and dedicated, and our goal has been and continues to be to feel like an in-house investment office to the foundation, down the hall, accessible, and responsive. So with that, why don't I pivot to our investment philosophy? We can take a look at that on page 8. Thank you. And it all starts with a long-term investment horizon. We are big believers that in order to be successful in investing, you really have to take the long view, and you have to be consistent and disciplined in sticking to an investment strategy that allows you to weather the inevitable bouts of volatility that markets will have. It really is inevitable. And you have to be able to withstand that so that you can benefit from the long-term upward trend in equity markets by staying fully invested. And so to do that, we need to develop a strategy that maps to, in this case, the foundation's unique ability and willingness to take risks. So we spend a lot of time on the front end of the relationship understanding what that looks like so that we build a portfolio that's aligned with that specific risk tolerance. We do believe in active management. We have active management in this portfolio. We believe in making these investments when we have a high degree of confidence that we will be paid to make those investments net of all fees and expenses. And if we don't have that confidence, we're perfectly happy to index. And indeed today we have about 20+% in passively managed strategies. So it's really not an either or, it's an all of the above approach in terms of active and passive management. And then lastly, risk management. It is really something that is an integrated approach. It's really integrated and embedded into everything that we do. It starts at the front end of the relationship where we work with the foundation to, again, understand that risk tolerance and then codify that in a set of policy guidelines that include things like strategic asset allocation targets, ranges, position concentration limits, and so forth. That ultimately becomes our rule book, if you will, that we use to manage the portfolio. It continues on through the actual building of the portfolio, portfolio construction, where we're looking to diversify by strategy style, cap, sector, you name it, source of return. And it's also position sizing, making sure that we're being thoughtful about the size of the investments that we make so that no one position determines success or failure. It's the basic, I should say, the basic day-to-day portfolio and risk management that we engage in, understanding the positioning of the portfolio, understanding what our managers are up to, understanding the risk exposures that we have, and making sure that we do everything in our ability to mitigate any unintended bets that we may have in the portfolio. And so it really is something that's integrated, holistic, and really permeates everything that we do. Okay, so if you look at the next page, to give you a sense, this is how we think about building portfolios. For portfolios that have a similar sort of return growth trajectory that we're ultimately trying to achieve here, we have to have a high allocation to equity. And so we very much are big believers in equity heavy portfolios through both public equity and private investments to drive that long-term portfolio growth. And then we use what I referred to earlier as diversifying strategies. Again, this is a mix of traditional long-short equity, event-driven hedge funds, as well as a combination of some less correlated liquid alternatives that help us essentially manage the risk that we take by holding equities. Because if we're going to have equities, we're ideally going to get more return, but we are also going to have periods of a higher degree of volatility. And so we use these diversifying strategies to help us manage that overall risk profile. And then finally, we build in the portfolio. You could think of them in a way as sort of shock absorbers. I think of them as liquidity reserves, if you will, that are meant to provide flexibility, ballast, liquidity in very specific macroeconomic scenarios. One such scenario that we get concerned about is a period of unexpected inflation, which can be very damaging in the short term to other investments that we have in the portfolio, namely the equities. We also seek to guard against deflation, economic contraction. Think about what happened last year, essentially. And so we typically hold things like treasuries and other high quality bonds in that part of the portfolio, again, to provide us that liquidity and diversification. It's about buying time. And so what you will see is, having that flexibility allows us to both rebalance, particularly in more challenging market environments, while also supporting the draws that this portfolio will make. So it's a very important building block of the portfolio, if you will. Let's take a look at the next page. Thank you, Sam. So this is an exhibit we often show to clients. This is just another way to provide a little more of our thinking around why diversification is so important. This is what we refer to as the quilt. There's a ton going on here. I don't want people to read it too closely because it's just going to get confusing. But the point is, what we're showing you for the last 20 years is asset class performance, best to worst, top to bottom, for every single year over that period. And then when you look at that, what we're trying to make the point that we're trying to make, I should say, is that asset class leadership in any given year will rotate. And any given leader in this year will likely be not the leader the next year, may even be the loser in the following year. And so from our perspective, when we think about portfolio construction, of course, we are not looking to load up on any 1, 2, 3 types of assets. We're really looking to try to have diversified exposure across these different types of assets, acknowledging that reality, that you will see that leadership rotate year to year over time. If we can do that, we should be able to deliver a more consistent, smooth return pattern with less of that sort of volatility that you'd have if you were just invested in one or two types of assets. And then lastly, page 12, we include this because oftentimes we will have clients ask us, well, what is your kind of near-term view and how are you thinking about positioning the portfolio within that context? And the answer, it isn't always very exciting, but it's true, is that we're really not going to be looking to position this portfolio based on a kind of 3 to 6 to 9 month view. Because first, we think it's incredibly difficult to predict what's going to happen. We've experienced it time and time again, and we really don't think that that's a good way to manage portfolios. We think the key to success, as I said at the outset, is having the strategy and sticking to it. But in any case, this is a nice example of why we really don't believe in making what I would refer to as sort of those market timing bets. And I would just focus on the top chart. What the top chart is showing you is the annualized return of the S&P 500 over the last 40 plus years. And that's on the left-hand side. So the S&P is effectively compounded at 12% per annum over the last 40 years, with significant volatility, I might add. If you were just to take out the 10 best days over those 40 plus years, your return would decrease by 1/3. Now, that's a big number in and of itself if you think about the return that you forego by just being out of the market and trying to time it. Just to quantify that for you, on a $100 million portfolio over 10 years, that's a difference of close to $80 million. So that difference in compounding is real. And it's why we really try not to make these timing bets and really focus more on what is the right strategy for you and how do we do everything we can to stick to it and stay as fully invested according to it over the long term. Okay. So with that, what I'm going to do is put myself on mute, and I'm going to give the microphone to Tim to continue.
Great, thanks, Omar, and wonderful to see all of you. I'm going to go ahead and jump to the first page of the market returns. It's actually the only page. Just to orient you, it's a returns for a number of different asset classes. The left bar is the quarter to date, the third quarter of 2021, and the right hand chart is the year to date. So for a number of different asset classes. Both bonds and equities declined together in September. The prospect of interest rates going up and asset purchase tapering by central banks globally was a major theme. And in fact, this was actually the first time since the onset of the COVID-19 pandemic that equities traded downwards. Of course, there's a number of things happening in the market, but those actions by central banks was certainly a major theme. A direct impact for bonds was for gains that were occurring earlier in the quarter to end up being erased. Bonds, generally speaking, were roughly flat on the quarter. Elsewhere, so-called long duration stocks, technology stocks, which are more impacted by interest rate changes, underperformed. The technology heavy NASDAQ index trailed broader US equities. Elsewhere, you can see kind of the outlier to the positive side, right in the middle of the left-hand chart. That's Japan. They were the major outlier on the positive side. Japanese stocks rose just under 5%, 4.6% in the third quarter, generally around hopes of a new administration and some kind of positivity. They had elections in October. On the negative side of the ledger, the outlier was emerging markets. They were the major outlier to the negative side. They were down 8.1% for the quarter. Mainly due to concerns around China, and Chinese stocks actually make up roughly a third of the emerging market index, and Chinese stocks were down 18%. So the major contributor to the negative performance in emerging market stocks. Other factors also contributed to capital market performance, and those include a continuation of a COVID-related slowdown. Again, this is third quarter. There was this kind of the height of what was going on with case count tied to the Delta variant, though it does appear that many countries are past the peak number of cases tied to the Delta variant. That also includes the US. Of course, it depends on the geography, but it continues to be a major theme. Markets have certainly not moved past it. A rise in COVID cases during the third quarter likely did things like dampened retail sales and had an impact on economic momentum, which is still in expansionary territory, but economic momentum did moderate in the third quarter. Again, I mentioned Chinese stocks, just concerns about China. Broadly speaking, it's the second largest economy globally, behind the US. Things like a concern around debt in their real estate sector, which is a very large portion of their economy. There was a major player, a company called Evergrande, teetered towards bankruptcy, and there were some concerns that bankruptcy from Evergrande would cause some contagion in other parts of the economy. And there was general just a slowdown in the Chinese economy, and there was even recently exacerbated by things like power shortages. Elsewhere, you've probably all read about this if you read the news, like the Wall Street Journal, really actually anywhere, it's pretty widely reported. There's been a persistence of supply chain issues as the supply side of the economy has acted as a bit of a headwind during this recovery. A case in point is the widely reported chip shortage, which has impacted the auto industry. If any of you have shopped for a car, not a lot of cars on the lot, and that's certainly been an impact. The supply chain story has impacted other parts of the economy. That's a good case in point. Commodities, broadly speaking, were the best performing asset class for the quarter. That was led by energy's double-digit gains. But if you look at different commodities such as gold and others, they were actually flat or down for the quarter. That brings us to where we are year to date. In equities, that's the blue portion of that right-hand bar. U.S. equities have led the way, but other developed markets are also doing well, and commodities are also the largest returner for capital markets thus far year to date. Though looking back farther, commodities have been extremely volatile. if you have sharp eyes and you saw it in that quilt chart that Omar had up a few moments ago, actually commodities were the worst performer last year. So, it's a bit of a reversal there. I'm going to push ahead actually to the next section, which is the portfolio update. If there are any capital market related questions, please feel free to put it in the chat, and we'll be happy to kind of dive deeper to any of the themes that I mentioned. Here, top of the page is portfolio growth. That dark blue bar is the starting value when we started working with the portfolio. That's in mid 2016. As Mary mentioned, it's been pretty remarkable that it's been 5 years. We're very excited to reach that milestone, but also over that 5-year time period, it's been great to see that assets have actually doubled. So they started at 64 million, and through the end of September, they've reached about 131 million, or a gain of 67 million. So again, total assets doubling. Of that 67 million, there have been net portfolio inflows. However, the bulk of that appreciation, the vast majority, has come from investment performance. About 55 million of that increase is from investment performance. Looking at the bottom of the chart, we're looking at portfolio performance versus its benchmark for a number of different time periods, going back to 2016 all the way where we are today. The foundation portfolio has returned over 10% since inception. That's annualized or compounded per annum. That's the farthest right-hand bar, versus the policy benchmark returned at 9.7% for 2021, though it's not over, but we're 75% of the way there, which is pretty remarkable. It seems like the year started yesterday, but it's been another a solid year thus far. Portfolio has returned over 10% for the first 9 months of the year, and that's versus a policy benchmark return of 8.7%. So strong absolute returns, as well as some nice relative value add versus the policy benchmark thus far. For the third quarter, portfolio roughly flat, down 0.2%. Earlier in the year, the portfolio was up 4% in the first quarter and 6.4% in the second quarter. Largest contributor, especially for those first 2 quarters, has been private investments. Omar mentioned up over 30% for the year to date. So they've done very, very well and helped the portfolio perform well for the first part of for the year. Looking back, 2020, it's kind of right in the middle of the page if you can read it. If you can't, it's fine. I'm happy to talk through it. Portfolio also had a really good year. So we're 2021 is turning to be a solid year thus far, and that's following a 2020, which saw the portfolio appreciate almost 16%, which is a great return in absolute terms, but also some nice value add as a portfolio benchmark was up about 13.4%. And then that also follows a solid year in 2019 as a portfolio. It was up 19%. So again, a few years strung together, doing quite well. If we jump ahead to the next page, we can take a look at some of the asset class drivers of the returns I was just talking about. Top of the page is third quarter asset class performance for the portfolio. Bottom of the page is year to date. Global equities, I think I said this prior, but they declined for the first time since the onset of the pandemic. However, US equities did hold up. Our US equities are up 0.4%, followed by developed ex-US equities, which were down slightly. Think of economies like the UK and Japan. Those are major economies in the developed ex-US equity space, down 0.5%. Global equities, we have some managers that they go everywhere. So global is all markets, down a little under 2%. And then emerging markets, which despite being down 6.5%, that's that light blue bar in the middle, did outperform the broader emerging market benchmark, which was down 8.1%. There was certainly some volatility there. Purple magenta bar right in the middle are diversifying strategies. Happy to report they held up in a market or in a quarter with some volatility, up a little shy of 1%. Commodities, the orange bar, up a little over 5% for the third quarter. Tips, which are Treasury inflation protected securities, up a bit over 1%. And then treasuries up 0.3%. And then if we look bottom part of the page, this is a little bit longer, 9 months. So the first 9 months of the year. In terms of equities, US has led the way, and it has for a couple years now. up over 15%, followed by global equities up just shy of 12%. Developed ex-US equities are up 10.6%, and then emerging markets, again, despite some volatility which occurred mainly in the third quarter, are up positive, producing some value, excuse me, versus the benchmark, up 1.5%. Diversifying strategies, purple bar in the middle, up 5.8%, and commodities have really had a strong rebound as the economy reopened, and really powering the recovery. The demand for commodities has increased significantly. There has been a bit of a supply-demand imbalance, which has fed through to commodity price appreciation, and we've seen most commodities trade upwards. This basket of commodities that we hold is up 28%, or just under 28%. Treasury inflation protected securities up 4%, and then treasuries traded down moderately, up 5.6%. Looking longer term, exact same page on the next page, same page, but this is over a bit over a 5-year time period. This is since inception, so same asset classes. Here, unsurprisingly, equities have led the way. This is outside of private investments. US equities up over 16%, global up 12%, developed ex-US equities up about 11%, EM up 9.4%. Not on this page because there's a lag in reporting, but private investments since inception are up over 36%. So really kind of being the return driver that we hope they would be. Really good story over this 5-year time period. Again, up about 36%. Elsewhere, diversifying strategies up a little shy of 5%. That's that middle bar. Commodities, which I think we saw the bar on the prior page, really up quite a bit, but have been a very volatile place to invest. This commodity price volatility has been there, up just over 1%. Treasury inflation protected securities, that's that light orange bar, up 3%. And then the farthest bar to the right are treasuries, up 2.5%. And collectively, since inception, 5-year, 2-month time period, that brings the portfolio to an annualized return of 10.1%. Versus a benchmark return of 9.7%. So I'll pause there because I would love to see if anyone has any comments or questions, whether about capital markets, the portfolio performance.
And Sam, maybe you could take that slide down. Thanks.
Thank you, Tim. Thank you, Omar. Anyone have any questions or comments thus far?
Yeah, should we barge in with questions, Mary?
You ready, Omar? Are you pausing now, or tell us what you're looking for?
We're ready.
Okay. Yes, this is a good time for questions. Open it up.
I was curious. I saw real estate listed in a couple of places within your charts. I didn't take notes specifically. Where does, since the real estate market has been so volatile or remarkable, I don't know if volatile is really the way to describe these last couple of years. Where does that fit in say the last charts as you're tracking investments?
Are you asking within the context of the portfolio?
Right, exactly.
Yeah. So we don't have a dedicated allocation to things like REITs, for example, so public real estate, or a dedicated allocation to private real estate within our private investment allocation. We have the ability to have that exposure to the extent that we work with a private investment fund that might be focused on that sector. We've generally found on the private side, at least, we think we can get better returns from other sort of sub-strategies within private investments, buyout, venture, growth equity, and so forth. On the public side for the REITs, there's a lot of, we found generally that they trade quite a bit like an equity, and we have a significant amount of equity sort of already in the portfolio. So that's sort of the thinking for why we don't necessarily have a dedicated allocation. to the extent that there is a view that there's some, there's an opportunity there, or there's a desire to be a little more tactical there, where we would likely have that exposure would be within the diversifying strategies category. Those are the managers that have a much more flexible mandate. And if they're finding value, if they're finding an inefficiency, if they're finding a tactical opportunity, what have you, that's likely where we're going to find that exposure. And so, to the extent those investments do well, and obviously our managers have exposure, that's likely where you're going to see that benefit reside. But in terms of dedicated exposure, again, for the reasons that I described, that's why we don't have it, but we would benefit from it if there is a view that there's an opportunity there, and that would be in that more flexible part of the portfolio.
Great, thank you.
Yeah.
Thanks, Bill. Any other questions for Omar and the team? I'm scrolling through my iPad, making eye contact with those of you who are on video so I can see if there are any questions. Margaret, Bernie, others. Anything in the chat, Teal?
I don't see anything yet.
Great, great. Well, I don't think we all just need to hang out on Zoom looking at each other if there are no questions, although it is nice to see people. Appreciate you patching in, pausing a little bit just to make sure people, if they have questions and are having a hard time getting off of mute, they have time to do that. But I think a year and a half in, most of us have figured out the technology, how to unmute ourselves. And so please, if you have a question, jump in, and also know that if you think of something after the webinar and you have a question, you can send that in to us at the Community Foundation. And probably the best place to do that would send it to teal@mtcf.org, and then we can get your question answered and get it back to you. We will be uploading this presentation onto our website. We're grateful for those of you who patched in today, and any last minute things that I failed to mention, Teal or Omar, team.
I think you covered it.
Okay, well, we're grateful to have Cambridge as our outsourced CIO. We're happy to see Omar and the team, and it's so good to see so many of you as well. So have a great week. Have a wonderful holiday that's coming up. I hope you eat lots of turkey if you're a turkey eater, or get lots of good pie. And we'll look forward to seeing you when we have our next webinar. So thanks for joining us today, everyone.
Thanks
See ya.
all.
Okay.
Well, thank you.
Bye.